Hi, it's Carl Allen. Welcome to module number 6. So this is all about offers and negotiations. So last time we spoke, I recapped a number of the key takeaways from the module 5 training, which was all about the numbers, the financial analysis, including interpreting the income statements, the balance sheets, the cash flows, and then also looking at the valuation methods and the models that we use, as well as the indicative financing for closing payments. So we went through an income statement, a balance sheet, and a cash flow for a deal that I'm currently doing. Then I took you through a whole bunch of ratios and analysis so that you can see how the business is financially performing and what benchmarks you should be looking to see when you're analyzing a really good business. And remember, we're looking for distressed sellers of good businesses. And now you know what a good business looks like in terms of the ratios and the analysis. And I took you through the two valuation methods, the enterprise value or the EV method and the balance sheet method. And we also went through the merger model so you can understand how much economic value add or EVA your deal is going to generate through the cross-selling and cost synergies of combining the two businesses together. And we also discussed what that means in terms of the valuation of your new expanded empire and ultimately the increase in your personal net worth as the owner. So let me ask you a question. Did you do the work? It's really important that you did the work, because if you didn't, this module, it's going to be completely useless to you. You can't make an offer on a business until you've done the financial analysis work to come up with the numbers. So if you haven't done the work from module 5, please go back and do the work and then come back to this module armed with your financial valuation models. And as long as you have the numbers, it won't take you very long. Come back and revisit this module once you've done all of that work. So module 6, as in all modules, it's 4 lessons. In this lesson, I'm going to take you through some simple deal structures, and we'll get into this in a lot more detail in the legal lesson in module number 8, deal execution. But I just want to show you the differences between asset-based deals and equity-based deals and the concepts of subsidiaries, also known as special purpose vehicles or SPVs, holding companies, and so on. But more importantly, I'm going to take you through offer sequencing. So this is a big play on how we negotiate. It's a big part of our negotiation framework. We prepare lots of different offers up front so that we're always 2 or 3 steps ahead of the seller when counter offers come in on deals, but I'll go through that in detail. Now in lesson 2, I'm going to show you how to actually submit an offer, and I'll share my template for doing that. Then in lessons 3 and 4, we're really going to get into the negotiation strategy and tactics. In lesson 3, I'll walk you through my simple negotiation playbook, and I'm really going to open the can on my advanced negotiation tactics in lesson number 4. And I'll share with you some case studies and some war stories on how I've negotiated deals in the past. So I'll teach you the basic stuff in lesson 3 and go into the advanced stuff in lesson number 4. So when it comes to deal structures, I want to introduce you to a couple of key elements. One is the difference between buying assets and buying shares or buying equity, and what are the pros and cons are for both you and the seller in terms of how those deals get structured. Again, we get into that and the corporate structures in a lot more detail in the legal lesson. But this may impact how you make the offer and you structure the deal now. And there's basically 2 ways you can buy someone's business. First, you can buy their legal entity, which is an equity-based structure. So if you're buying a business and it's an LLC or an S Corp or even a C Corp in the US, or in the UK, it could be a limited company, an LTD, or it could be an LLP, a limited liability partnership, or if you're buying businesses in Australia, they're called PTYs. You're basically buying the same thing. You're buying the legal entity of the business. Now, the other method of acquiring businesses is just to buy the assets. So you're not buying the legal structure, the legal entity, the business that everything's within. You're basically just buying the assets, and then you're going to hive them, transfer them into your existing operation into your existing group of businesses. And there's no right or wrong answer. And I want to kind of walk you through what the pros and cons are of each method. Now, personally, I always buy the shares. I always buy the equity, but that's just the way I do deals. Other deal makers that I know very well, they only buy assets. So let me take you through the 6 or 7 variables that you need to consider. So first of all, we look at the level of due diligence. On this chart, green means that it's good, red means it's not so good, orange means it's average, a bit like a traffic light system. So when you're buying a business, if it's an equity-based deal, then your level of due diligence is going to be quite high because you're inheriting all of the business, the legal structure, meaning on an equity-based deal, there's going to be more detailed due diligence around the legalities of the business. So who owns it? Is there any pending litigation? All those different things. There'll be a lot more financial due diligence as well. Did the company pay their taxes and did they file their returns on time? All those different things. Whereas if you're just buying the assets of a business, your due diligence is only going to really be on the assets you're acquiring, the fixed and those working capital assets. And I took you through all of those in the financing module number 5. Now, you'll also do due diligence on the goodwill value, the business's ability to generate revenues and income going forward. And we applied that in our balance sheet valuation method. So you're still going to be doing due diligence on the customer base, on the market fit, on the SWOT analysis and all those different things. So that's for an asset-based deal. And we get into due diligence in a lot more detail as part of deal execution in module number 8. Just know for now, if you're doing an equity-based deal, it's going to be a higher amount of due diligence. If you're going to be doing an asset-based deal, it's going to be lower. And equity-based deals also take longer because there's more work to do. There's obviously a longer time to actually close the deal. So normally, from having an offer accepted to closing the deal, you're looking at about 8 weeks. In most cases, you'll be raising financing to do the deal, to make the closing payment. And that's one of the reasons why it takes a lot more time. If you're just bolting the assets into your existing business and you're potentially buying those assets just with seller financing, then obviously you can close the deal much, much faster. But if you're raising financing for an asset-based deal, you will have to leverage your existing business because you need a legal entity with a credit rating to raise money for a deal. But in general, asset-based deals are faster than equity-based deals. The next thing to consider is how selective you are on what you want to buy. So if you're looking at a business, if you're buying the shares in an equity-based deal, you get the warts and all. You're buying all the assets, all the liabilities, all the good things, all the bad things, all the employees and so on. On the other hand, if you're doing an asset-based deal, it's a bit like an a la carte menu. You can actually pick and choose what you want to take and what you don't want to take. You might just want to take the assets, the goodwill and the brand, but then leave all the liabilities behind and reflect that in your valuation. And for example, you might not want to take all the employees with you, although in countries like the UK, there's a provision called 2P, which means that if you're buying assets from a business, you still have to take the employees with you. It's the transfer of protection of employees. It's really, really important. So when you're buying the shares, not only are you inheriting the reputation and the goodwill of the business, but you're also inheriting the credit rating. So if the business has got great credit, it makes perfect sense to buy the shares because you can use that credit rating to raise financing. If you're just buying the assets, you may be able to use the goodwill of the business, the brand name, the trading history. But because you're just buying a set of assets without the legal entity, the reputational goodwill is lower and the credit rating, unfortunately, doesn't transfer. You would have to use the credit of your existing legal entity, whether it's an LLC or a limited company or whatever it is. And then when you buy the shares of a business, you're also inheriting the risk. So anything that's happened in the past, more legally and financially, you're getting those. But there are 2 ways that we protect against that. First, as part of due diligence, by law, the seller has to disclose any and all things that have happened in the business. And they have to warrant, like they paid the taxes, they have to warrant that their financials are as they've been recorded and filed. And they have to indemnify you against any potential legal issues that could crop up from the past once you own the business. And again, we get into a lot more of that in the legal module. But as an example, let's say the company you're buying has an employee issue, that somebody was fired and that former employee is kind of planning on suing the business, litigating against the business. And if you acquire the shares in that business, then you're inheriting that liability. So if we uncover something like that during our due diligence, we're going to ask the seller to provide warranties or indemnities so that if those things come back to bite us in the future, they can be passed on to the seller. And obviously, when you're buying the assets, none of that matters because you're just buying the physical things. You're not buying any of the issues that the company may or may not have had in the past. Now, second, a share-based acquisition is a lot more tax efficient for the seller. And in most countries, especially the UK, there's a much bigger tax incentive to sell shares versus assets. And that's good for you as the buyer. You can offer less in an equity-based deal because there'll be more money crediting the seller's bank account. So for example, if you were paying $2 million for a business on an equity-based deal, the seller's going to see a lot more of that money in his or her bank account thanks to the much more efficient tax structure. Next, let's look at corporate structures. Now, again, we're going to go into this in more detail in the legal module, but I want to quickly show you 5 of the most common. So first off, you've got your current company. So an LLC, S Corp, LTD, whatever that may be. You may have founded that already. So you've just got that one entity. So to go and acquire another business, then it makes sense to effectively have a new top co or a new holding company. That's much cleaner than transferring the target company into your existing company. Keeping them separate is really important because if, for whatever reason, something goes wrong with the target company that you buy, it's not going to bring down your entire group. It's a separate legal entity that you can take it out the back and shoot it or break it down, and your existing operations don't change. Now, if you were doing an asset-based deal, again, it's cleaner to set up a new corporate structure. So you'd have your top co, your holding co, which you'd introduce, that would own your current business. And then you'd set up another subsidiary, which could be an LLC or whatever SPV, special purpose vehicle that you want to create. And then that would be used to acquire the target company's assets. And whilst you can bolt the assets directly into your existing business, again, if there was ever a problem, it's just a worst case scenario. It's safer to keep it separate from your existing business. The next structure is if you buy a business with a property, a piece of real estate. So again, it makes sense to separate it and put that into a holding company. So in this example, now we've got 4 legal entities. You've got your existing legal entity, your current company, you've got your top co, which now owns the group, you've got the target company that you're buying, but then there's this real estate or property that you're taking as part of the deal. Now, rather than keep that within the existing business, I'd recommend you put that property within a separate company. Then you can have a rental agreement, a rental contract between those two. So again, if anything happens to the business you're buying, you can blow that company up, but still have the property to sell and do something else with it. That won't come down as part of the overall situation. This is all about risk management. And you can do the same with like intellectual property or IP. So if you're in the technology industry and you're buying a business that's got intellectual property, spin off the IP into a new little subsidiary. So again, if the target company was to fail, then your IP is still owned independently. And because it has monetary value, you can license it to somebody else or use it within your existing business. Next, let's look at offer sequencing. So this is a massive, massive core part of our negotiation strategy where we prepare up to 6 offers in sequence. We make an initial offer to the seller and then use the other offers in sequence when and if the seller counters those offers. And what's great about offer sequencing is that we're going to be paying the absolute minimum amount that we need to pay in a structure that works for us. And it works in 2 ways. We'll show you how to prepare all these in a minute. But say, for example, that you've got a business that you're looking at where it's a broker deal and the seller has got really inflated value expectations, then offer one may very well get countered. So you put in offer two and so on. And as you incrementally make these offers every 3 to 4 days, we keep the seller sweating. It makes the seller really think that you're returning to your numbers and rerunning your models, and you're talking to your financial partners and all those different things. So eventually you'll see the movement from the seller, even with the seller that has a really inflated value expectation. But if you've been leveraging the deal-making triad properly, and you've got that highly motivated or distressed seller of a good business, you'll see the movement happen a lot quicker. And it might be that offer 1 or 2 or 3 gets accepted rather than offers 4, 5, and 6. But I'll show you in a minute how by having much more inflated offers actually doesn't cost you A, any more money, and B, affect the cover ratio. That most important ratio, that greater than 1.5 ratio in the green box, that auto calculated in the valuation. So just to summarize, these were the outputs from the modeling that we did in our example deal in module 5. So here's an output for the EV method using the multiple of EBITDA, and also the balance sheet method where we're taking the net asset value of the business plus that goodwill that we calculated. So the valuation range for 100% of the equity was kind of in the $1.9 million to $2.7 million range. And stripping that back down to enterprise value, just to value the business, was $1.6 million to $1.9 million. So for the offer sequence, we now go and prepare 6 offers. So the first one is based on the summary that you had before. And all I do is I make the first offer just with 75% of the calculated closing payment. Offer 2 will be 100% of the calculated closing payment. And then for subsequent offers, I can sweeten the deal in 4 different ways. So offer number 3 will be to just add 1 additional year to the seller financing. It doesn't change the cover ratio or the financing, it just means you're paying for the business for 1 extra year. And if you're scaling the business and you're leveraging all those cross-selling opportunities and all those deal synergies, you could be able to do that much faster. Offer number 4 is where I introduce something called an earnout, which I'll talk you through in a minute. Offer number 5 is you leave the seller with, say, 10% of the equity. So you only buy 90% of their business and leave them with either 10%. And then offer number 6 is where you sell some equity to an investor to raise more capital, which means you can make a higher closing payment. But again, you won't own 100% of the business. You're going to have a minority investor in there. Whilst it's a bad thing to get too diluted, if that investor that partners with you can add massive value to the continued growth of your business, then it's not such a bad thing. So let's go through the examples. So again, our original valuation was between 1.7 and $1.9 million with a closing payment of $844,800. So offer 1 will be to reduce that by 25% to $633,600. Now the $830,000 of seller financing, that stays the same. The debt that we're inheriting is the same. There's no earnout, there's no retained equity, and there's no selling equity to anybody else like an investor. So we're offering about $1.85 million for that business, and our payment cover is 1.8. Now, if that offer gets rejected or it gets countered, then you already have offer number 2 ready to roll. But wait 3 to 4 days, then make offer 2, which is offering the full closing payment, the seller financing, and the debt. So offer number 2 would be 2.07 million, a little above the top of the range. That's an increase of about 11.4% or $211,000 on your opening offer. Again, the cover ratio doesn't change. Now that offer might get accepted, or you might get another counter offer, in which case we go to offer number 3 if we need to. So again, it's the exact same closing payment, but this time we're going to add an extra year of seller financing. So the seller financing for this deal goes from $830,000 up to just over 1.1 million by adding that extra year. The annual payment stays the same. The debt inherited stays the same. We're just adding a fourth year. Earnout, retained equity, selling equity, we haven't done that yet. So now we're offering $2.3 million and change for this business. And the payment cover is still 1.8. And it's a total payout increase of nearly $490,000. We've actually increased our original offer now by 26%. So it's starting to get really, really interesting. It's still a safe deal. We've still got a payment cover of 1.8, and we're not raising any more money. So if necessary, if you really like the business and the seller's really negotiating hard with you, then if you need to, you can move to offer 4, which is the same closing payment, the same 4 years of seller financing, the same debt that you're inheriting. But what we do now is introduce something called an earnout. Now, an earnout is where you're giving the seller bonus payments for increased future performance of the business. So a seller might say, look, I want $2.7 million for this business because I've got all of these contracts that I've just won and they're all going to be paying off in the next couple of years. It's going to be a lot more revenue, a lot more cash flow that you're going to see washing through this business. So, I want a little piece of that. So you could isolate them and then you can pay the earnout when that incremental profit is realized. I do a whole lesson on earnouts in a lot more detail in module number 7, financing, but think of an earnout as a kind of bonus payment to the seller above the current levels of profitability. So it's only going to be a win-win situation. So let's say we offer a $400,000 earnout as part of this deal, or $100,000 per year on our 4-year payment structure. So that takes the total deal value to just over $2.7 million. That's maybe what the seller wants. So now this is $888,000 above your opening offer. It's a 47.9% increase. So you're really going over the top to buy this business if you need to, but it's not costing you any more money and your payment cover remains the same. And normally, when I get to offer 4, if that's declined, I just move on to a different deal. But in some cases, if this business is going to generate so much economic value add for your net worth and the value of your existing business, then there are 2 other steps. But just be mindful of deal heat and make sure you've got lots of deals in your funnel. But if you really want to go to town on a deal, the next step is you can let the seller retain 10% of the equity. So again, if offer number 4, our total deal value was about 2.74 million. If you would turn to offer 5 and said, okay, Mr. Seller, I'm only going to buy 90%. I'm only going to leave you with 10% of the business. Then technically, you're adding another $274,000 to the valuation because you're letting the seller keep that little piece of equity. So now that takes your offer over a $3 million valuation, but your payment cover, it's still 1.8, as you know, and we've increased our offer now by over $1.1 million, or 62.6% for an offer number 1. And then if you absolutely, really, really need to, offer number 6 will be offer 5, plus you can then go and sell a 10% equity stake to an outside investor. Again, $274,000. And if this business is absolutely mission critical to you, you've got no other deals on the table, and this deal is going to drive massive amounts of EVA and wealth creation for you, then you might well consider diluting your equity. It's better to own 80% or 90% of something than 100% of nothing. So offer 6 is now $3.3 million almost. The cover ratio, the payment cover is the same. It's 1.8. That's not changing. But now we're offering more than $1.4 million, or 77.4% more than in offer number 1. And it's not costing us any more money. We've extended seller financing by a year. We've added an earnout bonus. We've let the seller keep 10% of the business. And we've sold another 10% of the business to someone else, which means that we can buy it because we get that extra capital we can pay at closing. So that's it for lesson number 1. I'll see you next on lesson number 2, where we'll go through how to submit your offers, and I will see you then. Until then, bye for now.